Welcome to The Explainer. Today we're going to tackle one of the absolute biggest mistakes that investors make. And it's not about choosing the wrong stocks. It's about choosing investments that just don't match their goals. See, risk by itself isn't good or bad. The real danger is when it's misaligned with what you're actually trying to do. Okay, so let's just dive right in with a really fundamental question. One that truly separates successful wealth building from just, taking a chance. It gets right to the heart of why we even invest in the first place. So, what's the core difference? Well, according to Investopedia, it's not really just about risk. It's all about the odds. See, investing is a long-term game. Over time, the expected return is positive. The odds are actually stacked in your favor. But gambling? That's a short-lived event where the house always, and I mean always, has the edge. It is designed for a negative return. And this idea brings us to a huge mindset shift, one that really separates beginners from experienced investors. It's all about moving from a simple question of how much to a much more powerful question of for what. Think about it. Returns are completely meaningless without context. A 20% return sounds incredible, right? But what if you needed that money next year and had to risk it all to get there? Yeah, suddenly it's a disaster. It's not about chasing the highest number. It's about what that number actually needs to do for you. And check this out. This is what's so interesting. This data from Morningstar shows this massive disconnect. When they asked advisors what they thought their clients valued most, maximize my returns was number one. But when they asked investors themselves, they ranked helps me reach my financial goals as way, way more important. And honestly, this isn't that surprising. For years, the story we've been sold by the industry has been all about beating the market, right? Chasing that performance. But the true, deep-down purpose of investing is so much more personal. It's about making sure you have the resources to live the life you actually want. Okay, so how do we make this shift? How do we get from chasing returns to actually achieving our goals? Well, it all starts with a really clear, actionable framework called goals-based investing. Now, as Wilmington Trust outlines it, this method just completely flips the script. Success is no longer about outperforming the S&P 500. Nope. It's about a much more important question. Are you on track to meet your objectives? Your progress is measured against your life, not some random market benchmark. So here it is. This is the 6-step roadmap to get your investments aligned with your life. This is how you build a plan that serves you, not the other way around. Let's dig into the most critical parts. First step, your goal can't be some fantasy like get rich. It needs to be specific, like a down payment for a house. It needs a deadline, say, in 7 years. And it has to be personal to you. This clarity is exactly what creates the discipline you're going to need later on. Next, time. Time is the single most important factor in deciding how much risk to take. For money you need soon, you need stability because you have zero time to recover from a big market drop. But for long-term goals like retirement, you absolutely need to take on risk to beat inflation and actually grow your money. In that case, time is your greatest ally. Now let's clarify two terms that get confused all the time with a little help from Investopedia. Your risk tolerance is your emotional willingness to take risks. It's all about how you feel during a downturn. Your risk capacity, on the other hand, is your financial ability to take risks. It's about how much you can objectively afford to lose. You have to respect both of these. And here's the bottom line. The most brilliant, high-return investment strategy in the world is completely useless if you panic and sell at the worst possible time. The best plan is always, always the one you can actually stick with, especially when things get scary. So let's switch gears and see how this all plays out in the real world. What happens when this alignment goes wrong? We're going to look at some common and very costly mistakes. This case study from Oath Law illustrates the danger just perfectly. Mary's husband had always managed their finances, but after he was gone, she was left to navigate a portfolio that was just completely wrong for her new reality. I mean, this portfolio wasn't just numbers on a page. It was creating real daily anxiety for her. It was threatening her wealth with taxes and hidden fees, and it could have created an absolute legal nightmare for her heirs. This is the real human cost of misalignment. And Mary's story isn't unique at all. Research from My Intelligent Investor highlights these 3 classic pitfalls, and they all stem from the same root cause, a fundamental misunderstanding of how to match risk to goals. You're either taking too much risk, too little, or planning for a future that's going to be way more expensive than today. But, and this is a big but, when you get this right,
The benefits go so far beyond just your account balance. This is where the real value is unlocked.
Honestly, the biggest payoff is psychological. It's confidence. It's peace of mind, because you finally have a plan that makes sense for you. Those wild market swings, they stop being a reason to panic and instead just become an expected part of the journey. You're no longer reacting to all the noise. And this improved behavior, it naturally leads to better financial outcomes. It's not that you've suddenly found a way to predict the markets. Not at all. It's that you've stopped being your own worst enemy. You avoid those big emotional mistakes that can completely derail your long-term growth. So if there's one key takeaway, it's this. Risk is not something to be feared or avoided at all costs. It's a powerful tool that, when you use it intentionally and correctly, helps you build the future you actually want. And that is how real investors succeed. They start with the why, and only then do they figure out the how. Thanks so much for joining us for this explainer. Now, my question for you is, what goal are you going to start planning for today?